So today in our four corners of Roth conversions, what are the four corners that we're going to talk about today? Well, first off, we're going to talk about the bracket max conversions. I could have picked a better name that maybe flows off the tongue. Bracket max conversions. After that, we'll talk about market timing conversions, what that is. And then the last two, we might have heard about the backdoor, but there's also a mega backdoor Roth conversion. So we'll talk about those two as well, and the specifics where those may be important. So our bracket max conversions for you taking notes, the bracket max, market timing, the backdoor, and the mega backdoor. So let's begin with our first one. The bracket max conversion. What does that mean? What are we referring to? Well, you might have guessed it, referring to the tax bracket. And by the name, you might be able to conclude we're maxing out a particular tax bracket. So how do we do that? Well, let's talk a little bit about its purpose. The bracket max conversions, its purpose is endeavoring to minimize the impact of RMDs, required minimum distributions, later in life. Up until a few years ago, based on life expectancy tables, when we needed to start taking RMDs, this was an even larger impact than it is today. Life expectancies have been extended, which has actually lowered the RMD amounts. By extending the life expectancy tables, I'll say that again, it's actually lowered the required minimum distributions as a dollar for dollar basis as a percentage of your portfolio. But that's its purpose. The bracket max, the goal is to fill up an ordinary income tax bracket, preferably before RMDs, required minimum distributions, start, so that later in life, and what do I mean by that? Somewhere in the mid to late 80s, where now we see RMDs begin to impact the tax situation. So what does that mean? Well, you can see here on our chart a little bit. I've got a little pen. I know it's very, very busy, but we see here a box. Just to explain here, this is a period of time that is before when RMDs begin. Currently, it's at age 73. It's extended to 75 by the year 2033. Used to be 70 and a half. So as I mentioned, recent changes to life expectancy and when those RMDs begin has impacted a bit of this strategy. But we see this green here. This is in some geological table of showing here. We see this green area is just that. It's that bracket max conversion, the impact. Down at the bottom is our age. So again, we see this spike coming up towards the end. So this is what we're trying to minimize. It's this late in life right here, this late in life peak as a result of taxation because of RMDs. In this particular graphic, it shows that we have done a bracket max conversion, meaning that we have filled up a tax bracket up to the 22% tax bracket over those periods of time from retirement. At this hypothetical example, at age 66 until 73, we filled up that tax bracket. So as a result, the impact here has impacted. This is what it currently is. This is what it would have been. So this here, we're getting a little busy, but this is the savings. So what we're trying to avoid with this. So that's its objective. That's what we're trying to achieve with this. Let me go ahead and get rid of that ink there, just busying it up. So how do we go about doing that? Well, it takes some in-depth analysis and some projections to evaluate where we're currently at, our current age when RMDs start, our current tax situation, projected income as well. So taking income sources such as Social Security, pensions, other distributions, tax benefits, taxable benefits as well, factoring all of that in the projections to determine what the actual real impact may be. And in this particular instance here, this graphic, just as kind of a side note, we found that the bracket max conversion really wasn't in the client's best interest. Though it did save, as we pointed out, it did save a bit late in life on taxation of those RMDs, that peak that we highlighted here, did save a bit on that. However, keeping in mind that each of these conversions also results in immediate taxation. So comparing what we'd be paying up front versus what we'd be saving in the back end, simple math, we can compare now. So when does this generally work out to be the benefit? Well, it generally works out to be in the client's best interest if we're already into those middle tax brackets. So we quickly, as a tax system here in the US, quickly escalate from 0 to 10 to 15 and so on and so forth. Those quickly get eaten up. But once you're into the 22 to 24%, so if you're already in that tax bracket based on all your other income sources, then we've got kind of a wide moat to work with, where we're not really adding any more tax or jumping into a higher tax bracket. So if you're already in that one, that's when it's best. So if we're already in the tax bracket, that's where this strategy generally works out to be in the favor. In this particular client's case, they weren't. They would have been a much lower tax bracket during that period of time prior to RMDs, which is why jumping up into a higher tax bracket didn't make sense for this particular client. So those are some of the things that we evaluate with the bracket max Roth conversion. And one thing I forgot to touch upon is what these RMDs are with some recent changes. I kind of highlighted that a couple times, extending the life expectancy tables and pushing back when RMDs begin. What does that roughly mean? Well, going back in time a bit, it meant somebody who was around 85 could expect somewhere around the 8 to 9% distribution. Today, that's changed. Now it's roughly around 7% withdrawal, meaning that if you had $1 million in your IRA, the IRS at 85 would require you to take out 7%, or roughly about 70,000. At 90, that jumps to roughly about 9%. So somebody who's in their late 80s and 90s who does not need $70,000 to $90,000, we're paying extra in taxes than what we need to. Okay. So I know those were just high level. Feel free to include in the chat if you have any questions on this, or feel free to reach out to me directly. I know this is a complicated strategy that takes a little bit of projections and planning. We're happy to discuss to see if this may work best for you. That's our bracket max. Market timing is a little bit simpler. So this one won't take as much paper if you're taking notes. Market timing conversions. What's the purpose of this? Well, as the name entails, we're timing the market, not from a stock perspective, but taking advantage of low times in the market, where Roth conversions may be a little bit more attractive. How so? Well, if your IRA balance is lower, then now's an especially good time then to take advantage of that conversion, because for every dollar that you convert out of the IRA, you'll be taxed upon that. So it just makes sense that in low points in market activity, like what we have highlighted here, they do come around. We're in that period now. Many seek to take advantage of these low periods and convert. So that's a much simpler approach. Our next is the backdoor. Now we get back to a little bit more complicated strategy with this, the backdoor Roth conversions. Now, why do we need this? Well, what's the point of this backdoor Roth conversions? Well, in fact, the contributions to Roth IRAs, the income limits for those, some are not eligible based on income limits. So if you make a certain amount of money, you're not able to contribute. How do we get that money in there? Well, the ability to contribute to a traditional IRA is higher. And so what we can do with this, we see here, we can do a non-deductible traditional IRA contribution. So for individuals, see the income limits, 153,000 for single, 228,000 for married. So if we're in those ranges there, we can make the non-deductible traditional contribution. So how does this work? Well, to get that money into a Roth IRA where we wouldn't normally be able to contribute. So this is not necessarily how you envision a conversion. Like you've worked a number of years, you've amassed a large 401k savings and you decide to convert. Unlike our previous ones, in this particular case, this is more of an ongoing. Each year, we're doing a conversion. To do that, we open up a new traditional IRA. We open up a new traditional IRA and fund it with whatever the max is for that year, 7,000 for the traditional IRA with catch up and so forth. So we fund that. And then immediately, after we've opened up a new Roth IRA, we convert the traditional IRA funds into your Roth IRA. From there, that conversion, because it's non-deductible, we'll pay the normal income taxes on it, but we'll notice here that we're able to get those funds into the Roth without directly contributing to the Roth. Now, pause. There are several 5-year rules. There's about 3 different 5-year rules. It just helps to keep track of, for record keeping purpose when you opened it up, when you converted that first conversion, and so on and so forth. And any sort of non-deductible IRA contributions will be an extra form, the 8606 for non-deductible IRAs. So it's an extra form to go through this, it's not super complicated, but not as straightforward as just contributing straight to your Roth IRA. So in this particular sense, yes, we can get those monies into a Roth IRA through a backdoor by contributing on a non-deductible basis to our traditional IRA, converting each year to the Roth. Who might this be best for? Well, this would be for those who high income earners that aren't eligible for what we talked about, Roth IRAs and a deductible traditional IRA. So high income earners, this is especially useful. If you qualify for a Roth IRA contribution, then just do so straight and avoid yourself the extra headaches of this. So higher income earners, this is a way to make Roth contributions. Okay, so now we have the similar, we have the concept of a backdoor by taking other non-deductible contributions and then converting them over into, now it's a similar approach, is the mega backdoor. So we think about the mega being larger. It's a very similar strategy as the regular backdoor, but this is done typically through a qualified plan like your 401k. So this allows us to make those after-tax contributions to a Roth IRA up to the IRS max. How so? Well, first off, not everyone is eligible. We have to have in the qualified plan 2 requirements. So first, the plan has to allow after-tax contributions. And 2, it has to allow in-service Roth conversions. So many older plans, that may not even be an option. If you're a small business owner, tightly held corporation, you might be able to refresh your retirement plan and include these. So if you're tightly held corporation, you're a business owner, and you may feel like you might want to take advantage of this. It might be good to refresh, take a look at your current plan, and maybe add on some of these provisions. But those are the two requirements in order to take advantage of a mega backdoor. Is it has to allow after-tax contributions, and it has to allow an in-service Roth conversion. So now we got a couple of numbers on the screen there that you can see. These numbers are a bit dated. I've got the current numbers off and to the left, but just for visuals, we see the dark blue side. This represents here our pre-tax contributions. So this would be like what you would contribute normally on a pre-tax basis, and then you've got the matching contribution. So this is what the company would contribute. Now, if you're the business owner, tightly held corporation, that's kind of one and the same, right? You can make your personal plus on the business side, so you can add those together. So 22,500 deferral plus whatever matching provisions that you allow. Now, the light blue here, now this, again, if you're able to contribute on an after-tax basis, you contribute up to the annual exclusion limit. So filling it up, adding this plus this, whatever's left. If you're able to contribute on an after-tax basis for 2023 up to $66,000. So 22 plus whatever the matching is. So again, you might be able to on an after-tax basis, tack on another almost $40,000 into the plan on an after-tax basis. So what do we do from there? We add up all of those, and then from there, that's where that in-service Roth conversion comes in, is when we can then take that after-tax amount and then convert it to a Roth. So if the plan allows for that, we can contribute up to the maximum and then do that. Otherwise, Roth contributions, standard Roth contributions would be subject to that same deferral limit there. So what's nice about this, again, kind of like a backdoor done each year. You want to do it instantaneously, because any dollar amount, if you contributed $35,000 in after tax and you forget to convert it to a Roth, that 35 has now grown to 40. You'll pay some income taxes on that spread. So, when you make that contribution, you want to set it up immediately that you're going to be making in-service Roth conversions, so you don't have to pay the tax on it. So who's this good for? Well, this is a nice provision for those who are already maxing out their 401k. So if this allows, we can avoid the whole backdoor, the last slide, we can avoid the backdoor strategy, and we can employ this. So if you're an employee of a company, maxing out your 401k, this might be a good approach. If you're a business owner, again, this is also another nice provision, because you'll have control over those two qualifications, the after-tax and the in-service conversion. You can refresh your plan, allow that to happen, and again, be able to maximize that deferral limits in there, and still keep a safe harbor plan for your employees not breaking anything. You don't have to tack on any other fringe benefits or other non-qualified plans that may just add some complexity to the benefits. This is a way of doing that. So that's our mega backdoor conversion. So hopefully you found this beneficial today. We talked about the 4 corners of Roth conversions. You remember we talked first about the bracket max. The only way to really determine that would be an in-depth analysis of current income and your income sources and some projections. We also talked about market timing, which is now many find this to be a useful time to convert because markets are low. And then the last two would be for those who are maxing out what is available, and higher income earners that can't take advantage of maybe some of the other resources. So hopefully you found this beneficial. And again, if you have any questions, feel free to reach out to myself or my associate Chris, who's on this call as well. Feel free to reach out to us directly, and we'd be glad to answer any questions that you may have. Again, thank you for your time, and we hope to see you next month for our next Plan Series webinar. Take care.